Volatility Indicators. As we said, this lecture, quite a large chunk of it will be focused on volatility indicators. Now when we talk about Bollinger Bands or the average true range or moving average envelopes, these are all indicators that tell us about the volatility in the market. Now, if you remember in an earlier lecture, I believe it was one of the first lectures, we did an example of Bollinger Bands. So we actually looked at them in Excel and saw how they worked, or we looked at them in a chart. And what we're going to do in this lecture is do that again, this time in a lot more detail, so we can see exactly how to calculate it. Now, of all the volatility indicators, the Bollinger Bands is probably the most commonly used, and moving average envelopes and average true range are also used quite a lot as well. Now, what is a volatility indicator? Well, a volatility indicator, quite often, they consists of lower and upper channels, right, or lower and upper band. So you can think of the price sequence and two lines around that sequence, one above, one below, and that is your volatility channel. And what the channel tells us is that where the price is expected to fluctuate in between. So we have this channel, let's say we have an upper band and a lower band, then we expect that the price will be within this band. Now, how does this band actually measure volatility? Well, if we have a very wide channel, okay, that would imply that volatility is high, right? The range of prices that prices can move in is high. If we have a narrow channel, that indicates that volatility may be low, that the range that the price can move in is smaller, and that implies lower volatility. And so that's some indicators look like that with the channels. We also have other indicators that may just give us a single value that will tell us how volatile the market is. And this will actually be the case for the average true range. Now, why is it important to know about volatility? A couple of reasons. One, it is a very important component of the market. Volatility is a measure of risk. It tells us how risky something is. And assets often go through periods of high and low volatility. So volatility is also not constant. So sometimes volatility will be very high and sometimes it will be low, and this will depend on the market conditions. So one important tip is that it's a good idea to stay out of the market during highly volatile periods. Often when volatility is very high, the price movement is more unpredictable and potential gains and losses are very high, so it's a good idea to stay out of the market. Another interesting feature of volatility is breakouts. A breakout obviously is when the price moves up or down in a particular direction, and breakouts often follow periods of low volatility. And this is just an empirically observed fact. And so we can use volatility for these reasons, and of course other reasons, for which we'll come to later on in this lecture. Bollinger Bands. The first indicator we are going to talk about is Bollinger Bands. And as we said earlier, this is one of the most common volatility indicators used. Now you can pronounce this as Bollinger Bands. Some people do that. I will use Bollinger Bands, though I feel both are acceptable. Now, what is a Bollinger Band? Now, as we mentioned in the last slide, the Bollinger Bands will have an upper and a lower band. Okay, so we have two bands that come out of the Bollinger Band. And this upper and lower band represents the level between which the price should trade given the current level of volatility. So what we do with the Bollinger Band is that we say, well, we look at the volatility based on previous data, and then we calculate a channel between which the price should move based on the volatility. Okay? Let's now break down how exactly do we calculate the Bollinger Band. So we have two bands here. The upper band and the lower band are equal to two standard deviations above and below the end date, usually a 20-day simple moving average respectively. Let's break that down to understand exactly what it means and how we would calculate the Bollinger Band. The first thing we would need to do is calculate the simple moving average, the 20-day simple moving average. The next thing we need to do is calculate the standard deviation of that moving average, for which we'll use the price relative to the simple moving average over the last 20 days. And then the upper band is equal to 2 times the standard deviation added to the moving average, and the lower band is 2 times the standard deviation subtracted from the moving average. And then we'll get a Bollinger Band, an upper and a lower band that represent the volatility of the asset. So how do we actually trade using Bollinger Bands? In general, prices are expected to bounce off the upper and lower bands. So if the price hits an upper band, we can think of that as a natural resistance level. It should fall down. If the price falls to the lower band, we can think of that as a natural support from which the prices should rise. Essentially, because the price is expected to stay within this channel, we should trade when it goes outside because we expect it to come back. That's essentially how the Bollinger Band works. Sometimes we use Bollinger Bands to find breakouts. If we see a break through a band, that may signal a breakout and a new trend in the same direction of the break. So there are really two different ways we can use Bollinger Bands. What we're going to do now is we're going to look at Bollinger Bands first on the internet in Yahoo Finance on a chart, and after that we will look at it in Excel, where we'll actually go through the calculation in a little bit more detail. Bollinger Bands. Now here we have a 1-year chart of the Nifty index, and we've been using this similar chart throughout our examples. And what we are going to do is that we are going to plot the Bollinger Band on this graph so you can see what it looks like. This is a standard technical indicator included in Yahoo Finance and will generally be included in most free technical analysis packages. Now just to keep in mind, the other indicators that we'll be going through in the rest of this lecture we will not be seeing on Yahoo Finance because they're not included. And these indicators will not necessarily be on a free software like this. But for Bollinger Bands they are, so we can go ahead and look at them. So I just have to go up to technical indicators here and click on Bollinger Bands. Now here we have two parameters to input. One is the period, and this is the number of days moving average. Remember I said in the slide that we need an n-day moving average, and the default of this is actually 20. So we'll go ahead and use 20 here. The next thing we need is the deviation, which is the number of standard deviations we want the band to be away from the moving average. And this is the default is 2, so we will stick with that. So we're going to stick with 20-day moving average and 2 standard deviations away. So let me draw this now. Okay, now you see these two lines here. So if you follow my cursor from the beginning, where we have a red line on the top, which is the upper band, and a red line on the bottom, which is the lower band. And this now represents the band between which prices should remain. Now if we just look at the prices, what we'll see is that most of the time it stays in this band. So the first place is really down here. So if you look at my screen, it's on just past October, where this little hand is. Over here, this is where it hits the bottom of the band, and then it promptly rises back up. Okay, so you can see here it's bouncing off the band, and likewise over here it bounces off the band. It slightly breaks it, but comes back down fairly quickly. Now there are some instances where it does not work as well. So if you turn your attention to over here, you'll see that it bounces off the top of the band here, but doesn't really come back down afterwards. The band kind of rises along with the price. The prices still stay within the band, but this, for example, would not be a trading opportunity, right? You could, if you took a short position here in the expectation that it would bounce off, you would be disappointed because even though the price stayed within the band, it moved upwards. So as you can see, it's not an indicator that's going to tell you exactly when to take a position. You can use it for specific positions, but it is a volatility indicator. It's more likely to tell us where the price should remain within. However, quite a lot of the time you can see that if it bounces off the one end of the band, it promptly goes in the opposite direction. So even around here, for example, it bounces off the top of the band, falls back down. Bounces off the top of the band here and falls back down. Here bounces off the bottom and goes back up. So this gives us an idea of what a Bollinger Band looks like. And the areas where the bands are wider, that indicates that the price is more volatile and we can expect greater movements. Places where the band is narrower indicates that volatility is lower and we can expect less movements. If we, for example, look over here, we'll see that the band is actually fairly narrow, right? Narrow as compared with, say, over here. And in this case, the price is also still staying within the band. So the fact that it's lower volatility is making a difference here. So now that we've had a chance to look at Bollinger Bands on Yahoo Finance, we're going to now turn to Excel, where we'll actually look at how to calculate Bollinger Bands, and then we'll see them in more detail. Bollinger Bands. Here we are now in Excel, and here I have the Nifty Index, which is the same dataset that we have been working with so far throughout this course. I've got the Nifty Index from the end of 2011, starting with the beginning of 2005. This time it's slightly different in that I have the open, high, low, and close. Previously I just had closing prices, but this time I have all four price sets, and that's because one of the indicators that we'll calculate later on requires the open, high, low, and close, not just the closing price. So that's the first data set. The second data set I have for this Excel sheet is the stock price of Maruti. Okay, and this is just the closing price because that's all we need, and I also have the volume, right? So this is the number of shares traded on that day of this stock. So this is again from early 2005 till the end of 2011, and this we'll be using for one of the indicators too. So let's now go to the Bollinger Band tab, where we'll look at how to calculate the Bollinger Band, and here I just have the Nifty Index and the closing prices. So I don't actually need the open, high, and the low for the Bollinger Band, hence I have not included it. And one useful tip I would give is that whenever you're doing these kinds of Excel exercises, only take the data that you need for that indicator or whatever set of indicators you're calculating. You don't need to have everything there if you're not going to use it. It just makes it more simple. Okay, so let's start by calculating the Bollinger Band. The Bollinger Band, as we said, is equal to you have a lower band and an upper band, which is equal to the moving average times 2 times the standard deviation. And we're going to use the 20-day moving average and consequently the 20-day standard deviation. The first thing we need to do in order to calculate the Bollinger Band, okay, is calculate the simple moving average. So I'm going to write on the top here SMA 20, which means 20 days simple moving average. And this is simply going to be equal to the average of the closing prices over the last 20 days. So this will be from B2, okay, until B21. And that should be 20 days. I'll just verify that. Okay, so that's fine. Now I have the 20-day simple moving average. I can copy this down all the way. And again, these last 20 days values will not be worth a lot because of the fact that it's not using the full data set. So for example, this calculation is using data that's not available. But that's okay. We don't really care about the ones at the bottom. We'll just stick to the ones at the top. Following the 20-day simple moving average, I need to now calculate the standard deviation. Okay, so this I'm going to call the standard deviation, and this is the standard deviation using the 20-day moving average, and it's a 20-day standard deviation. So what we need to do is it's actually fairly simple. We just do the standard deviation, okay, of the last 20 days. Alright, copy this all the way down, and what you can see is that this actually takes into account the average of the 20 days as well. So this is, you can just do this, you can calculate the standard deviation of the last 20 days. So let me put standard deviation 20 here to make that slightly more clear. So now we have moving average, 20-day moving average, and we have the 20-day standard deviation. Now calculating the upper band and lower band is pretty straightforward from here. So let's say I first want to do the lower band, and then I want the upper band. Now the lower band is equal to the moving average minus 2 times the standard deviation. So what I need to do here is say that the lower band is equal to this moving average here times, moving average minus 2 times the standard deviation. Okay? And the upper band, let me copy this all the way down. The upper band is going to be the same formula as the previous one. It'll be the moving average, except this time we're going to add 2 times the standard deviation. Alright, and now you can see these two values here. These two represent the upper and the lower band. Let me just tidy these up here so it looks a little bit more clean. And you can see the lower band is going to be always below the moving average, and the upper band will always be above the moving average, which makes sense. And sometimes the prices may come close to the upper and lower band, and we need to find out where this is the case. So what we wanted to do now, if we wanted to, for example, implement some kind of strategy, what we would do is we could look at instances where the moving average crosses the bands. So one way to do this, so if I wanted to calculate, say, crossing lower band, I could just say that if the moving average, if the price ends up below the lower band, that indicates a cross. That will be a 1. Otherwise, give me a 0. And you can see if I go down, there are a lot of zeros in here, but a few 1s. So there are many instances where we cross below the band. And if I wanted to calculate crossing the upper band, I could say if the upper band, if the price is higher than the upper band, then give me a 1, otherwise give me a 0. And now I have mostly zeros and a few 1s, and instances where the price crosses the upper band. And now we know the crosses, we can then devise our trading strategy as we like. Maybe use it as a breakout, maybe do it to take a reversal position. Obviously we have to try and do different things and see what does the best. Okay, so now that we've seen Bollinger Bands, we'll now move on to the next indicator. Moving average envelopes. The next indicator we're going to discuss is the moving average envelope. The moving average envelope is actually one that is a little bit simpler than the Bollinger Band. It's a similar indicator in that it creates an upper and lower band around the price. Alright, so if we want to think about how to interpret moving average envelopes, we would do it in pretty much the same way that we interpret Bollinger Bands. So we have this upper and lower band, and this represents the volatility of the asset and where the price should stay within. The difference in moving average envelopes is that their calculation is a bit more rudimentary. It's slightly less sophisticated. And what we need to do, which also makes it easier, by the way, so it's a much easier calculation than the Bollinger Band. We don't really need to worry about standard deviations or anything like that. So what we want to do is we will calculate first the simple moving average. Okay, so just like with the Bollinger Band, I would calculate a simple moving average. And for argument's sake, let's just assume that I'm going to use the 20-day moving average. And the upper band will be X% above the moving average, and the lower band will be X% below the moving average. So now let's just think about what that means. Okay, let's say I take X to be 5%. Alright? Then the upper band will be the moving average plus 5%. Okay, so 5% of that upper band we add to it. And the lower band would be 5% below that upper band. Below the moving average. So we would have a percentage above and below the moving average that creates our upper and lower band, for which we expect the prices will remain in. Now what makes this a slightly not as good calculation as the Bollinger Band is that we don't really have a way of picking this X%. So we could pick 2%, 5%, 10%, whatever we want really. It's not really a standard deviation, so the channel can get larger or smaller depending on what we pick. So in that sense, it doesn't really talk to us about volatility that much, because the Bollinger Bands really actually look at the standard deviation of the asset, which tells us something about volatility. This one doesn't really tell us that much about volatility because we have to create our own size of the band. But one advantage of this is that we can be much more flexible. So we can create the band such that we feel that it provides a good way of giving us the support and resistance and where the prices should bounce off. So it's really more of an exercise to try and find out what this right percentage is. So what we'll do now is we'll go into Excel and we are going to show you how to calculate the moving average envelopes, and we'll take it from there. Moving average envelope. Okay, let's now in Excel calculate the moving average envelope. So let me go on to the moving average envelope tab. And again, here I'm just going to have the closing prices because that is actually all I need. Alright, I do not need open, high, and low for this indicator. And let's go straight into it. So what we need to do is we first need to calculate the 20-day simple moving average, just like we did before. So I'm going to have SMA 20, and this is going to equal to the average of the last 20 days. Now, I just want to point out one thing here, is that we have been using the simple moving average in our calculations of the moving average envelope as well as the Bollinger Band. This is the default in the sense that this is how it's normally done, but there's no reason why you cannot use an exponential moving average. So sometimes Bollinger Bands are calculated with an exponential moving average, and sometimes moving average envelopes are also calculated with an exponential moving average. The more common way is to use the simple moving average, but I just want to point out that there's no reason why you can't do other things. And what we'll see, especially in the next module, is that technical analysis, to be successful, we really have to be able to tweak these indicators and be able to do that to suit what we want to do. So just because I present to you an indicator in a particular way, it doesn't mean that you can't change it if changing it means that it will be more successful. Alright, let's get back to our calculation. So now our moving average now becomes simply X%, alright, plus or minus the simple moving average, and that creates the envelope. So what I want to do is I want to calculate X to be a variety of different values. So for example, let's say I take 1%, okay, so let's calculate a lower band 1% and an upper band of 1%, okay. Now I'm going to try a couple of values here just to see what seems to give me a good result, or what seems to give me a decent range. And the lower 1% will be really easy to calculate. It's just going to be this value here, okay, minus the same value times 0.01. In fact, a better way to do this would just be 99% times this value, okay, and that's a 1% lower, essentially. Same thing. Copy this all the way down, and now I can calculate the same thing but 1% higher. So this will be 101% times the simple moving average. Okay, so we can see here that again this represents a band, and we expect prices to remain within this band. Now this is a very narrow band, as you can see, so already here the price is outside the band. So let's just do a lower cross of the 1% and then upper cross of the 1%. Okay, so a cross would be if the price is lower than this 1% band, then give me a 1, otherwise a 0. So you can see we have a lot of 1s here, especially a lot more than we had in the Bollinger Band case. And the upper band, I want if the price is greater than the upper band, then give me a 1, otherwise give me a 0. And again, you can see a fair amount of 1s. So what this tells us is that in this case, a 1% band is quite narrow because the price seems to cross it a lot. Let's now try a 3% band, and then I'll conclude with trying a 5% band. So let's do those calculations. So we have a lower 3% band, an upper 3% band, lower cross 3% band, upper cross 3% band. Then I'm going to do 4 more. So I'll just copy these across, but change these to 5%. And then we'll do it for 5% and see what happens when we're looking at how often does the price actually cross the band. Okay, so this is going to be a very similar calculation to this. So this will be the moving average. So now it's 3%, so we're going to do it times 97%. Copy that all the way down. And this one is going to equal that value, the closing price times 103%. Copy that all the way down. Then again, we're going to follow the same thing we did before. If the close is less than the lower 3% band, then give me a 1, otherwise a 0. If the close is greater than the 3% band, then give me a 1, otherwise give me a 0. Okay. Now let's do the 5% band. We'll just do the calculation quickly before talking about all of it at the end. The 5% band will be equal to closing price times 95% in the first case, and then the closing price times 105% in the second case. Okay. And again, we have the same formulas for the lower cross. So let me do these quickly. And then finally for the upper cross. Okay. So now you can see here we've calculated the lower and upper bands for 1%, 3%, and 5%. So let's just take a look at the lower crossings for the 3%. And as you can see, there are still quite a few ones here, much less than the 1% case. Okay, but still probably more than what we had with the Bollinger Bands themselves. So I think these would be narrower than the Bollinger Bands. When we go up to 5%, we see that the crosses are very infrequent. In fact, I don't see a single one right now. I'm sure we can find one. So maybe 5% is probably too great a value based on what it seems here. So maybe 4% would be good. I don't know. 3% seems quite good. There seems to be a lot of times when the 3% band is crossed. So really we have to play around with it and see what the best percentage number to use. And one thing to caution here is that the percentage number will depend on the simple moving average. So if you're using a 20-day or a 50-day moving average, the percentage that you need is going to be slightly different depending on the length of the moving average. That's why we can't really give you a fixed value of you have to use this for X, because it really depends on the length of the moving average you use and also the success of each one in a particular trading strategy. Okay, so now we've done this, we're now going to go on back into PowerPoint and look at our next indicator. Average true range. The next indicator we're going to talk about is called the average true range. Now this is also a volatility indicator. Like the Bollinger Band and like the moving average envelope, the average true range is a volatility indicator. It's a little bit different though. It doesn't create two different values. So whereas the Bollinger Band and the moving average envelope gave us two values, okay, that we considered to be the upper and lower band between which the price should fluctuate, the average true range just gives us one number, all right? And this represents the range of the price, okay? And really what we're looking at when we're looking at this average true range is how much does the price tend to move, all right, on a given day, okay? So we look at the change in prices over a day, and we want to look at the average of those changes, and that tells us how much can we expect the price to move in a day, or equivalently, how volatile is the price. So let's now go through how exactly do we calculate it. So to calculate the average true range, we first need the true range. The true range is going to be equal to these three values, or one of these three values. So we calculate three different ranges. The first range is today's high minus today's low. Alright, now in this indicator we're going to be using open, high, low, and close. The second range is today's high minus yesterday's close, the absolute value of that. Absolute value means we just take the positive number. So if today's high was less than yesterday's close, if we were to subtract it, we would get a negative value, but the absolute value just means we make it positive. The absolute value just looks at distance and not really concerned with the sign. The third range is today's low minus yesterday's close, and again the absolute value of that. So we have three different ranges that all represents how much has the price moved today relative to yesterday, or relative to its movement today. And the true range is the maximum of the three values above. So we're defining the true range as being the highest of those three calculations. Alright, so that is the true range. The average true range is an n-day exponential moving average of the true range. Alright, so we will calculate the true range for every single day. Alright, using the above three calculations and taking the maximum of that. We'll calculate the true range for every single day, and the average true range is an n-day EMA. So we'll use 14 days, that's the default for this indicator. A 14-day EMA of all these ranges. Now what do we learn from this indicator? Well, when the average true range is high, it means that volatility is high. Alright, when the average true range is low, it indicates a consolidation period, a sideways period, or low volatility. And you can think of the average true range as how much should the stock move on a given day. Okay? Let's now go into Excel and we'll see exactly how to calculate this. Average true range. Here we are back in Excel and we're on the moving average envelope tab, so I'm just going to take us to the average true range tab. Okay? Now what we're going to do now is calculate the average true range. We'll show you how to calculate this in Excel. Let's take a quick look at the data set. This is again this nifty index that we've been working with so far, the same data set from beginning 2005 to end of 2011. The big difference here is that we have the open, the high, and the low in addition to the close. Alright, and that's because we're going to need these items to calculate the average true range. The average true range, as we mentioned, has three different ranges associated with it. So we calculate three ranges. We take the maximum of those three ranges to be the true range, and then the average true range is an EMA of the true range, a 14-day EMA. Okay, so let's go straight into it. So what I'm going to do is I'm going to write three different columns, R1, R2, and R3. So remember we have three ranges that we need to calculate first to find the average true range. The first range is equal to today's high minus today's low. So I take today's high over here minus today's low. Okay, that's range 1. The second range is equal to today's high minus yesterday's close. And again, here I'm looking at the absolute value of this. So this is going to be today's high minus yesterday's close. And I want to take the absolute value of this. So what I need to do is just write ABS in front of the whole thing. So this ensures that I always have a positive number. Finally, the third range is equal to the absolute value of today's low minus yesterday's close. And again, I copy this all the way down. Make that nice and neat. And now we have the three ranges that we need. Now that we have the three ranges, let me just format these again. I don't think I did it properly. Okay, now we have the three ranges. The next thing we need to do is calculate the true range, which is simply a maximum of these three ranges. So I'm going to have a new column here called TR, true range. TR is equal to the maximum of R1, R2, and R3. Alright, so this is a simple function. It just takes the maximum of those values. And I copy this all the way down. And this is now my true range. Okay? Final step is to calculate the average true range, which is simply a 14-day exponential moving average of the true range. So now let's try and remember how we calculated the exponential moving average. We've done it previously. So what I need to do is first let me put an average true range over here. Go down to the bottom. Okay. Alright, so these values here, we have to ignore these because it's using one that doesn't exist. So let me start with this value here. The first thing we do is copy this value across. Okay. And we'll just copy it without the formula. So I'm just going to write it in. And that's what we're going to use for the first value of the EMA. And that's fine because obviously it will correct itself within about 14 days of it, as we've already discussed. Now the EMA is equal to the current price, or in this case it's going to be the current true range, minus the previous day's EMA times 2 divided by the number of days minus 1. So this is going to be a 14-day EMA. 14 minus 1. Alright. All of that. And then we add the previous day's EMA. Okay, and that's the 14-day EMA. Now if I copy this all the way up, what I get here is the average true range. So this value here, the average true range, is just a 14-day EMA of this true range here. This true range here is the maximum of these three ranges, and these three ranges just looks at the difference between prices on one day, either the same day or prices to the previous day. And that's how we calculate the average true range. So what can we really glean from this average true range? Well, we can look at the fact that the average true range represents how volatile is the asset. So if you look at these numbers here, you can see that it's kind of around 90 in the last 3 days here, so it's not very volatile here. It goes kind of in the hundreds up here, so it's more volatile. Then down here it's in the 90s and 80s. Here it's in the 120s, so you can see that the volatility changes a lot. Like here it's in the 60s, so it's quite low. So the average true range is an indicator that whereby the volatility does change quite frequently. Okay, now we'll go back into PowerPoint and take a look at our next indicator. Percentage volume oscillator. The next indicator we're going to talk about is the percentage volume oscillator. Now this is a completely different type of indicator to what we've seen so far. The percentage volume oscillator tells us about volume and what's happening to volume. So previously in the lecture we concentrated on these volatility indicators looking at the price. Now we're going to look at volume, and what's important here is to know from our prior lectures, especially in the previous module when we did chart patterns, is why is volume important. Volume is used to confirm the direction of a trend, etc. We can also create trading rules with volume. I just want to stress that we rarely use volume alone to create a trading rule. So even this kind of indicator that's based on volume should not be used on its own to create a trading strategy. We can use it with other indicators as well. So now let's go and figure out what this indicator is, but just keep that in mind what volume is useful for as we do this. So the percentage volume oscillator tells us the direction of volume. So it tells us whether volume is going up or volume is going down. And we use a fast and a slow moving average of volume. Okay? So the percentage volume oscillator, we take the fast volume moving average. So VMA in this case is volume moving average. We take the fast volume moving average divided by the slow volume moving average minus 1 times 100%. And what we get from here is that when the percentage volume oscillator is between 0 and 100%, it indicates that volume is increasing. When it's negative, so when it's between 0 and minus 100%, it indicates that volume is decreasing. So it's a really nice, simple way to tell us what's happening to volume. Alright, because sometimes if we just look at individual numbers, it can be distorted because sometimes, on particular days it might be very high or very low. This looks at volume averages, so it looks at it over a period of days and tells us whether that trend is indicating higher or lower volume. As we said, volume is used to confirm price trends. So if we see that prices are trending while volume is falling, that indicates a weakness in the trend, potentially a reversal. That's often the case, especially the case for uptrends. And if volume is rising along with a price trend, that indicates strength in the trend. So we obviously know what volume is for. I just wanted to re-emphasize it here on this slide, since we haven't really talked about it for a few lectures. Okay, so the next thing we're going to do is we're going to go back into Excel, and we will see exactly how to calculate this volume oscillator, the percentage volume oscillator. Percentage volume oscillator. Now here we are back in Excel, and we're going to now calculate the percentage volume oscillator. So if we go to this tab, this time I have a different stock. I have Maruti, which I showed you in the beginning of the lecture. So let me go back. Here, this is the same data here that we're using, Maruti data, and it's the closing price and the volume on the stock. The reason I did not use the Nifty index, because the Nifty index is just a index value. It's not something that is traded itself. Obviously, the stocks within it are traded, and ETFs and futures on the index are traded, etc. But the index itself does not have any volume, so I couldn't use that. So I took a stock, Maruti, which is obviously a big company and a fairly heavily traded stock, which has closing prices and volume with it, and we're going to use it to calculate the percentage volume oscillator. So just a quick look at these numbers tells us that volume does change. So here we see volume 1.6 million, or 16.8 lakhs. And you can see that it does move around quite a lot, right? So here it's a lot lower. So we can use, hopefully this percentage volume oscillator should give us something useful that we can use. Okay, the first thing we need to do is calculate a fast VMA and a slow VMA. And we'll just go with the simple moving average of volume here. Obviously you can try this with an exponential moving average of volume, but this will work fine. So for our exercise, let's take a 5-day volume moving average and a 20-day volume moving average as our fast and our slow. Okay, and again, obviously we can use a 20-day and a 50-day. We can use, whatever combination of fast and slow we want. Much like with moving averages, we can use whatever combination of fast and slow that we like. So let's go with 5 and 20. So I'm going to say the VMA 5 and VMA 20. VMA 5 is equal to the average of the volume over 5 days. Copy that all the way down. And the VMA 20 is equal to the average of volume over the last 20 days. Okay? And this goes all the way down as well. So this is a simple moving average. We've seen moving averages before in many different contexts, and the only real difference is that we're doing the moving average of the volume rather than the moving average of the price. The next step is to actually just calculate the percentage volume oscillator. All we need is the fast and the slow VMA, so it's a pretty easy calculation. So the PVO, and I'm going to call this PVO 520 because it's using the 5 and the 20 day. The PVO is going to be equal to the fast VMA divided by the slow VMA minus 1. Alright? And I want it in percentage terms. There we go. Okay, so this PVO now tells us what is happening to volume. Okay, and this minus 34% means volume is going down. And this magnitude of these numbers are really just telling us how much is the movement, how strong is the movement, right? So if we've got numbers that are, say, close to 0, so say like minus 9% is pretty close to zero, it means that volume isn't really changing very much. It's slightly decreasing. But if we go down, we can see we often get instances where numbers are a lot bigger. So look over here, we see 17%, 40%, 27%. And this indicates sort of fairly strong increases in volume, okay, from previous days. And you have quite large negatives as well. So you can see this indicator does move around quite a lot. It tells us what's happening to volume. So one way to use this is to say that I'm going to use this PVO to tell me whether volume is going up or down. Alright, so if I have an uptrend, then I want to see the PVO in positive territory, and the higher it is, the better. If I have a downtrend, then I want to see the PVO in negative territory, and the lower is the better. And this is using a 5 and 20 day VMA, so it's really looking at that time period of volume. So just like when we calculate a moving average of the price, it tells us the trend over that number of days, really. The same with the PVO. It looks at the volume over the last 5 days versus the last 20 days and what the difference is. So we can calculate further dated ones if we want. So let's say we wanted to do, let's say, a 10 and a 50 day. Alright? Just for argument's sake, I'm going to just calculate it to show you, and we'll see what the difference looks like. So I would do VMA 10, VMA 50, and with VMA 10, it will simply be the average of volume over the last 10 days. And VMA 50 is equal to the average of volume over the last 50 days. Sorry, that's the wrong column. That should be C. Okay. Next step is now to calculate the PVO of 10, 50, and this is going to be the same formula that we had here. We take the fast moving average divided by the slow moving average minus 1, and then in percentage form. Now what do we see here? Well, as we expected, because this is longer moving averages, this PVO is a bit less volatile than this PVO. Right, so this tends to move a bit slower. But it also gives us, kind of what we expect, that volume in certain directions. And we can see that numbers can get much bigger here because they move a lot slower. So now, when do we know, for example, how to use the 5 and 20 versus the 10 and 50? Well, a good thing to do is match it with the trend you're looking at. So if you're looking at trends that are looking at 10 days and 50 day moving averages or longerish trends, then you want to use a volume oscillator that reflects those trends. If you're looking at shorter trends, then you want to use a volume oscillator that's looking at smaller moving averages. So the best way to do this is to tailor it to what you're actually trading when it comes to looking at the trend. So it's good to use volume oscillators that are in line with the length of the trend you are looking at. Alright,